What's up everybody, I'm Jaspreet Singh and we have just received the worst inflation data yet. Now, while this new report says that the average inflation that Americans are seeing are 8.5%, that doesn't mean that the prices of everything that you're paying for has gone up by 8.5%. Like we've seen the prices of groceries rise by around 10%, we've seen meat prices rise by around 15%, we've seen home prices grow by around 19%, and we've seen gas prices grow by about 40%, all just within the last 12 months. Now, the interesting thing about this is as soon as we got this new inflation report that was worse than expected, which is the worst inflation report that we got yet, we saw the stock market rise because investors were hopeful that now inflation is finally peaking. Hey, we have the worst inflation report yet, but at least hopefully this is the worst report that we're gonna see. Now, some of you are probably hearing this saying something like, yeah, that 8.5% inflation is really bad, but my bank account shows that inflation is a lot higher than 8%. So what gives? Well, for one, remember the CPI data, this inflation data is just an average. So some things like the price of your food, your meat, your housing, your gas, these are all growing faster than 8%. And then you have some things like beer prices, which haven't grown by 8.5% over the last year. But the second part to that is how CPI is calculated, because if you look a little bit deeper as to how CPI is calculated, you're going to start to see how these numbers are a little bit, well, massaged. The best example that I can give you of this is just by looking at housing costs and how the CPI data takes a look at housing costs. So the inflation report that we have today in 2022, it doesn't look directly at housing costs when it calculates the CPI data. It looks at something called owner's equivalent rent. And now what owner's equivalent rent essentially means is you have these people that call up homeowners and they say, hey, if you were going to rent out your home tomorrow, how much would you rent out your home for? Now, most of these homeowners don't really have a good idea of how much money they would rent out their home for, so they just give whatever number they think is right. And then based off of this data that's gathered through these surveys, that's how the Federal Reserve Bank then classifies how much inflation that we see in the housing market. Like I dove deep into this last CPI report that we just got a couple of days ago, and you'll see that the owner's equivalent rent that we saw over the last 12 months from March 2021 to March 2022 was just 4.5%. So this new inflation report that we just got, which is the worst inflation report that we've seen since 1981, says that inflation is 8.5%. Now, out of that number, which they calculated, a quarter of the inflation data is derived from home prices. And what they said through their owner's equivalent rent is that home prices have gone up by 4.5%. Now, I've done a lot of research on the housing market. I mean, I'm a real estate investor, I'm an attorney, I'm also a real estate salesperson, so I work in the housing market, and nowhere can I find any data saying that home prices have gone up by just 4.5%. Everywhere I look, I see that home prices have been skyrocketing. We've seen home prices grow at record-breaking speeds. So on one hand, we have home prices which seem to be growing very fast. I mean, if you look around any neighborhood, you see home prices skyrocketing. But this inflation data that we're getting says that housing costs have only gone up by 4.5%. The reason why that is because sometime between the 1980s and now, the CPI data was changed. Back in the early 1980s, when you looked at housing prices, you actually looked at housing prices at rental prices. You didn't have owner's equivalent rent. This is a newer thing which is included in today's CPI report that wasn't included then. And the reason why is because, well, it makes inflation not look like it's as bad as it actually is. Now, 8.5% inflation is really, really bad. But it could be a whole lot worse if you actually looked at the real numbers. And so what does that do? Well, it allows the Federal Reserve Bank to continue on with the policies that they have, because if inflation doesn't look as bad as it actually is, then you can continue doing more inflationary policies, more money printing, lower interest rates. So it allows the Federal Reserve Bank and the government to continue on with certain policies if that's what they want to do, because the inflation reports don't look as bad as they actually could be. But now we're getting to a point where inflation is really starting to get out of hand. The Federal Reserve Bank is getting worried, the government's getting worried, and now they're having to start changing their policies because of how bad inflation is. Now what we're starting to see happen is a lot of finger pointing. We're seeing the Fed and the government start to say that Russia is a big cause of the inflation that we're facing right now. Let me actually show you a chart that the Bureau of Labor Statistics put together. That way you can understand why this is so important to understand. So this is a bar chart showing that the inflation that we've seen, and they say that overall we've seen 8.5% inflation, which is this red bar titled All Items. Now, if you hover over food, it says that food inflation has been 8.6% across all food categories, Energy inflation has been 32.9%, and then everything else except food and energy has been just 6.5% inflation. That means if 1 year ago your grocery bill cost you $100, your grocery bill today should be costing you $108. Or I'll be a little bit generous here and I'll say $109. So your $100 grocery bill should not be costing you more than $109, and everything else from your flights to your other cost of living besides gas should cost you just less than 7% more now than what it did before, according to their data. Now, if you are like most people, you understand that life is way more expensive than just 7% now than before, excluding food and energy. But these are the numbers that are being reported, and based off of these reported numbers, that's what the government and the Federal Reserve Bank are then taking action on, and that's what's influencing their monetary policies. This is why I've been saying since 2020 that inflation is going to get bad, and you need to get smart with your money because you can't always trust what the Federal Reserve Bank and the government are saying. Like, if we just go back to what has happened over the last 12 months, you start to see that it's really important for you to get financially educated. In July of 2021, less than a year ago, the government and the Federal Reserve Bank said that inflation was transitory, it's just temporary, when it was at 5%. In December of 2021, that's when inflation started to get worse, but President Biden came out and he said that inflation would cap out at 6.8%. That was December of 2021, and now here we are in March of 2022, and we have inflation at, well, 8.5%. Now I know there's a lot to process here because yesterday I made a video talking about how the Fed says that because of this oil crisis, we're probably going to be entering a recession, and then Deutsche Bank was the first major bank to come out and also say that the United States will be entering a recession in the next 12 to 18 months. So there's a lot to unpack here. Because on one hand, it seems like the chances of a recession are growing pretty quickly, and at the same time we have inflation, which hopefully is peaking, but it is very, very, very high. The reason why this is such a unique situation right now is because we are about to enter an inflation-induced recession. Now, typically, when you have a recession, it's caused by some sort of economic slowdown that's not due to inflation. Like if we go back to the 2008 crash, before that crash, inflation was hovering around 2%. And so when we entered that real estate meltdown and the financial meltdown, the Federal Reserve Bank was able to create more inflation through stimulus, through low interest rates, through quantitative easing. The Fed was able to do these type of loose monetary policies which caused more inflation in order to stimulate the economy. And that worked. We were able to get the economy running. Now, obviously, it didn't fix the problem, but it was able to get the economy running again. Now, here we are today. We're about to enter another recession, but we're entering a recession due to an economic slowdown caused by high inflation. So if you're entering a recession caused by high inflation, how do you then stimulate an economy to get out of the recession without making that inflation problem worse? Because anytime you do stimulus, anytime you cut interest rates, anytime you do quantitative easing, which is the typical ways that the Federal Reserve Bank stimulates a slowing economy, all of these things cause more inflation. So if our inflation is causing a recession, how are you going to get out of the recession? This is the dilemma that we're facing right now because the Federal Reserve Bank has to pick its poison. Are you going to fight a recession or are you going to fight inflation? Unfortunately, the reality that we're facing right now is if we want to fight this inflation that we're seeing right now and we want to get inflation down to a more reasonable level, something around 2%, which is what the Fed says that they want to do again and again and again. If we want to get inflation actually seriously down, we're going to have to cause a recession. And the way that you do that is by raising interest rates to tighten the monetary policy to save the strength of the dollar, but in turn, that is going to cause a recession. It is going to hurt the stock market, it is going to hurt the housing market, because that means interest rates are going to go up significantly, which makes borrowing money more expensive, which makes doing business more expensive, which would ultimately hurt businesses, which would ultimately hurt real estate, but it would save the dollar. On the flip side, the Fed is also worried about a recession. They don't want to see a recession, especially when you have midterm elections coming. And so the way you fight a recession is by stimulating the economy. Well, how do you stimulate the economy? You can cut interest rates, which makes borrowing money cheaper. You can throw more money into the economy. You can do more quantitative easing. But all of these things then cause more inflation, which in turn will make the economy even worse. The reason why we're seeing an economic slowdown is because people aren't able to spend as much money as they could before because everything is so much more expensive now than it was before. Even if we just stick with the CPI numbers where inflation is 8.5% a year, Well, over the last 12 months, wages have only gone up by 4.5%. Now, if you've been actually keeping up with the data, you know that the actual inflation that people are facing is higher than 8.5% a year, while the real wages that people are seeing haven't really grown that much. You've seen maybe 4.5%, 5% wage growth over the last year, while inflation is double that. So if the prices of things are growing this fast, while your wages are growing this fast, well, that means that you're gonna have to shrink your lifestyle. We've already seen credit card debt skyrocket, so people are being tapped out. People are running out of cash reserves, they're spending all their money, and so now they're having to shrink their lifestyle, which means businesses make less money, which ultimately hurts the economy. And so now the Fed has to make a decision. Which one are you gonna do? Are you gonna fight inflation, or are you gonna fight a recession? You can't do both at the same time, and if you try to do both at the same time, you're gonna have worse inflation and a worse recession. Now, before I move on to the topic of Russia, oil, and what you should be doing with your money right now, I do want to mention that if you like staying up to date on what's happening in the finance and business news like this, you can check out Market Briefs. It's a free financial newsletter that I created where our team breaks down exactly what's going on in the finance and business news. And every morning, you're going to get a fun and witty email that's going to break everything down in an easy to read email. You're actually going to look forward to reading this email every single morning. It's completely free. So if you want to join Market Briefs, I'll put the link to how you can do that down in the description below. Now, the interesting but not very surprising thing that we're starting to see happen is we're starting to see more blame go on to Russia for the inflation problem that we're seeing today. But the thing that I want to just remind you of is the inflation that we're seeing today was around before Russia invaded Ukraine. We've already been facing an inflation crisis since before 2022. The Russia and Ukraine now invasion and war just made the problem worse. Yes, oil prices are significantly higher now than before because of Russia's invasion of Ukraine, but that's not the cause of the inflation problem that we're seeing right now. It's just a trigger. It's just something making the inflation problem worse, but it was not the cause of the inflation that we're seeing now. Inflation at its core really has one cause. Now, I know there's a lot of different definitions of inflation out there, but at its core, inflation is when you inflate something. And what are we inflating when we talk about inflation? Well, the monetary supply, money. So when you increase the monetary supply, you create more inflation, which ultimately reduces the value of each individual dollar. Now, most people assume that inflation means the prices of things are going up, but that's a false definition. The price of things going up is a side effect of inflation. Now, you're not always going to see the price of things go up when you have inflation. You can see more inflation happen. You can see more dollars get printed. You can see the value of your dollars go down, but still see the prices of things go down if you start to see more, say, technological advances, more supply chain advances. You can see more innovations happen in business, causing the price of things to go down. But if you didn't have that inflation, the price of that item would have gone down even further. So inflation causes the price of things to go up because the value of the dollar goes down. So what we saw happen over the last 2 years or so now, I can't believe this pandemic has been going on for 2 years now. What we've seen happen for the last 2 years or so now is we saw a very loose monetary policy. What that means is the Federal Reserve Bank worked with the government to print trillions and trillions of dollars. This money was essentially printed out of thin air while no real wealth, no actual value was being produced. So we were producing money without producing any real value. We weren't producing any more actual products. We weren't producing any real money. We just kept producing more dollars. What it did is it devalued the currency, and then it caused a whole bunch of supply chain issues because no one's producing anything, but everybody has a whole bunch of money now. So now you can buy things without anything being produced, which caused a supply chain mess. And then on top of that, you have this Russia and Ukraine war, which is causing gas prices and oil prices to skyrocket, which ultimately affects the price of everything. So it's just been one thing after the next. And now the Fed finally has to start fighting inflation. And the way that they're going to do that is by raising interest rates. Now, we don't know how fast the Fed is actually going to fight inflation. The Fed says that now they're going to get serious about fighting inflation. They're going to get more aggressive. We're going to see a bunch of rate hikes in 2022. But I just want to remind you that if something happens, if we start to see a real slowdown in the economy, if we start to see this war get worse, if we see this pandemic come back, this could be a reason for the Fed to now say we're going to loosen our monetary policy, we're going to slow down this tightening policy because the tightening is going to hurt the economy. The Fed has been saying again and again that they're only willing to raise interest rates because our economy is strong, but if our economy isn't strong enough to continue tightening, will the Fed continue raising interest rates? Now, if your concern is inflation, then the answer should be yes. We need to save the dollar. We need to save this. And so the way you do that is by continuing to raise interest rates. It's painful. Fighting inflation is very painful, but that's better than having to deal with hyperinflation. It's better than having to deal with a dollar crisis and having a recession at the exact same time. So right now, we're really just trying to pick our poison, and it's not an easy option, but this is where you need to be financially educated, and you want to make sure you're using your money the right way. You want to have some cash put aside for your savings no matter what happens. If we see an economic slowdown, you lose your job, you want to have something to fall back on. Now, saving your money is the last thing that you want to do when you have a very high inflation problem, but you still need to have some sort of cushion to fall back on. Then you want to be investing your money. Obviously, you can invest your money in stocks and real estate, but you also want to consider having something like physical gold as kind of like a hedge, as real money if you have a real inflation problem. You can also consider owning some physical real estate. These are hard assets, things that you can see, feel, and touch as a way to protect your money. And then you can also consider investing some of your money in cryptocurrency if you believe in cryptocurrency and you believe in the blockchain technology. Now, don't just blindly throw your money into it if you don't understand it. Only invest your money in places where you understand. So stocks, real estate, physical gold, maybe some Bitcoin. If you enjoyed this video, here's a video on why the Federal Reserve Bank says that we're going to be entering a recession in the next year. Thank you for watching, and as always, keep hustling. So the Fed originally didn't want to raise interest rates until the economy was strong enough to withstand higher interest rates. Now here we are, the Fed has started to raise interest rates, and it turns out the economy wasn't strong enough yet.